Sanjeev Prasad from Kotak is now with us. Sanjeev, it's been a long wait, so to speak, with the market just dragging its feet up until 12th and then 16th. What's the right approach right now? Wait on the sidelines, see what the opinion polls are indicating, and then take a call on May 16th?
Well, I guess so. I guess at this point in time, the market seems to have already factored in an India government coming in with around 250 seats, I would think, with expectations of maybe slightly higher numbers. So let's wait and see what the exit polls have to say, and then that's on May 12th, and what the final results say on May 16th. So I'm not very sure you really want to jump in only for the sake of the election outcome, because the risk-reward balance is obviously not as good as it was, let's say, 2-3 months back, when many of the domestic cyclical sectors were trading at 20-30% below versus current levels. So even if you see the right outcome, let's say if you see India government getting 230-250 seats, I don't think you will see much of a reaction in the market. If, let's say, India gets to 270 plus seats on its own and is in a position to form the next government on a majority basis without any support of any other regional parties, then clearly it's going to be positive, and maybe the market will go up 5-7% with domestic cyclical names doing obviously very well, like sort of banking, maybe PSU energy names, industrial infrastructure names, autos, etc. But do keep in mind the fact that about 45-50% of the market comprises outsourcing names, consumer stories, etc., which may not do too well. So even the 50% of the market may go up another, let's say, 10%. Other 50% of the market will probably just be flat, or may also come off a little bit, with the result that you will see the broader market maybe going up about 5-7%. But more important thing is, if you see a very good government in place in terms of an absolute majority, then you can actually invest for the much longer term, next 3, 4, 5 years horizon, and play on the economic recovery which will take place, and also earnings recovery. So even though you may miss the 5-7% pop which may happen based on better than expected results on May 16th, you can still invest later on for next 3-4 years, and just play the compounding story of India.
Sanjeev, what are the kind of sound bites you are getting from your global institutional clients? If indeed NDA comes back with a thumping majority, would they increase their capital allocation to India, or for them the election outcome is more like a 5% event and they are not likely to change their portfolio strategy?
No, if you see India coming in with a majority, clearly it would be positive to start with. More important thing is what kind of economic policies are announced by the NDA, let's say between the time it forms the next government, which is, let's say, somewhere around end of May, to the time it presents its budget, which is probably early part of July. So if you see a series of announcements and actions at the same time, I think you could see a lot of money coming into India. If you see India in a relative context compared to the other large and emerging markets, it actually stands out very well. Most of the economic parameters are actually improving, whether it is GDP growth, inflation, fiscal deficit, current account, BOP. I mean, they're all on an improving trend. Compared to Brazil, Russia, China, India looks actually quite good. And also compared to the smaller emerging markets, Philippines and Indonesia, which have done well, they're already looking quite expensive compared to India. So in that sense, India looks relatively better positioned and can absorb a lot of money. It's a large market at the end of the day. So I think if you have a positive outcome of the election results, followed by the right economic agenda being laid out by the next government, you could actually see a lot more money coming in.
Sanjeev, for the moment, anything which has got to do with Gujarat is on a tear, be it Gujarat-based port companies, Gujarat-based fertilizer companies, or Gujarat-based state-owned companies. Do you think it's a matter of time economic reality would kick in? Do you think it's a matter of time Gujarat-based companies would revert back to their mean?
Well, I'm not very sure if things will change dramatically for the Gujarat-based PSU. Narendra Modi has been there for a long time and presumably is going to become the Prime Minister, but I'm not very sure whether that really changes anything for the Gujarat PSUs. They are reasonably well-run companies. Most of them, make profits. There's no interference from the state government, so I'm not very sure if anything changes dramatically. On the private companies over there, whether it is the power companies or the port companies, I assume, the policies which will be rolled out by the next government will apply equally across all the states. I don't see a situation where a central government is going to bias towards a particular state. I don't think that is going to be the case. So what people are probably hoping for is more favorable investment climate for the country based on some resolution of some of the operating challenges which have been plaguing the investment cycle. So based on that, I see some amount of optimism which is building around some of the private companies in Gujarat. But I think the same logic should more or less apply to the other parts of the country also. And to be fair, if you look at how the stocks have performed in the industrial infrastructure or even the entire PSU space, most of the stocks have got related quite significantly in the last 2-3 months on expectations of A, recovery in the investment cycle, and B, better operation of the PSUs, a better operating climate for them.
We've got a new listing today, Wonderla, and the subscription numbers look pretty handsome. It's a listing after a long dry spell. Does the business model interest you? Would you at all take a look at it once the listing number comes out?
Well, I haven't had a chance to look at the company, but I assume it's a play on consumer discretionary spending, which will keep on increasing over a period of time. But honestly, I don't have much sense of the company specific issues.
Sanjeev, you've always talked about your preference towards, as to how energy as well as, particular OMCs would benefit whenever the new government comes in, if it's a strong one at that, and the kind of policy reforms that they would bring in. Talk a little bit more about whether that theme continues to hold true for you. Energy and OMCs are still a sector that you would want to bet on?
This flows from a broader theme. If you look at what investors are looking at in India, and presumably if everybody is positive about positive changes going forward, broadly they would be in 3 areas. One is clearly the fiscal side. Fiscal consolidation would be one of the themes in the short term. The second area would be investment cycle, and all the issues relating to investment cycle will be fixed over a period of time. That's a more of a medium-term theme. And the third is just improvement in governance in the country, strengthening of democratic institutions, etc., etc. So that's more of a longer-term theme, I would say. But the work on all the 3 areas need to start immediately, I would say. Now, coming back to the fiscal theme, which is more relevant for the PSU energy companies and OMCs, our view has always been that any new government which comes in, assuming it has the right priorities and wants to take India onto a path of higher GDP growth, has to fix the fiscal issue to start with. And if you look at the options available to the next government, or is the case for the current one also, it's basically taxation reforms and subsidy reforms. I mean, there is no third way around it. On the taxation side, GST implementation would presumably happen by April 2015. The BJP is now in favor of it. Congress is always in favor of it. So presumably it will take place with all the issues being resolved over the next, let's say, 9-12 months, and April 1, 2015 GST is in place. Now, coming to the subsidy side, you've already seen the current government putting in the right framework for deregulating diesel prices over a period of time. And assume the next government, whoever comes in, if it has fiscal theme as an important economic issue, is probably going to continue with that, because I don't see how the fiscal situation in India is going to change without subsidies being cut over a period of time. And when I look at the overall subsidy numbers, it's somewhere about 3.5 trillion rupees if you include the power subsidies also. I mean, that's like 3% of GDP, which is ridiculous to me. I mean, if you put the same amount of money in education or infrastructure, that is something which is a lot more productive rather than wasting money on subsidies which the country cannot afford. So, it's a simple thing that any right-minded government will look at fixing the fiscal issue, and one of the beneficiaries of that would be lower subsidies for the oil sector, which in turn will benefit the OMCs as also the upstream companies.
A point that rather than getting excited about what could happen on 16th of May, for a market watcher, the big event really will be this year's budget. That's the time when the cat's going to come out of the bag and markets will really get a sense of the economic policy the new government is committed to follow. So rather than focusing on 16th May event, which could be a 4% swing, 5% uptake, 10% downside, just focus your energy around the budget.
See, there are two ways to look at it. One is obviously, what happens to the election outcome is going to precursor to the budget. I mean, if you have the right composition of the government, then you could see a much more favorable budget in the sense, it's much more economic friendly and a business friendly budget in that case. Whereas if you have a government, which has to rely on a lot of regional parties to form the next government, and the entire economic vision and agenda of the next government is going to get severely diluted. So you will have all sorts of pulls and pushes. The government will not be very strong. The economic positions in the cabinet they would be distributed over a number of smaller parties. So you don't really want that kind of a situation. What you want is the right government with a very clear economic vision and agenda, and whatever we have been hearing from the NDA, and it looks like it has got a plan in place. And assuming you have the right election outcome, in the sense whatever investors are assuming at this point in time that comes through, and the next government is in a position to implement the economic vision and agenda, I think this market is going to be on a much stronger footing for a very long time. I don't think it's just about elections now. As you rightly said, you will see that 5-7% pop. Assuming NDA gets close to 70, but don't write off a situation where the market will actually correct also if you don't see the right outcome in terms of whatever the market already assumed. The more important thing is obviously we get the right outcome followed by the right economic agenda over the next 2 to 3 months, including the budget.
Sanjeev, the last time we were chatting, you were talking about as to how ICICI Bank and Axis Bank are looking attractive. ICICI Bank has shown some strength of late. At 1550, does it still make an attractive buy?
It's about 1300 rupees as of now. So in terms of valuation adjusted for the value of subsidiaries, which you take at about, let's say, 274 fiscal 2015 basis, it would be somewhere about 1.7 times March 2015 book, about 1.5 times March 2016 book. So it doesn't look too bad in the context of hopefully an economic recovery, which should result in some of the concerns on credit costs being very high for an extended period of time. They would start to come off, and as a result of that, you would not only see some amount of earnings upgrades because of lower loan loss provisions or credit cost. You could also see a re-rating in the multiple. So I would be very surprised if in a good economic scenario, ICICI Bank could easily trade up to about, let's say, 2 times price to book, which means 2 times about 625 would take the book value for March 15 for the standalone business. So that's about 1250. You add about 300 rupees for the subsidiaries. The stock would be 1500 plus in, let's say, 17-18 months time, assuming everything falls in place. Right government, right economic agenda, economic recovery.
Right. So Sanjeev, broadly, are you making a case that one should focus on banks which have a greater economy focus and not on banks which have a strong retail focus? Something like an HDFC Bank has potential to underperform, but something like ICICI Bank, given that your view is that economy is on a mend, will do better?
I would think so. See, it's more of a case of rating in case of ICICI Bank. And also keep in mind the fact that HDFC Bank is already, has a very large base in terms of the retail business. So to grow it consistently at 20% plus, which it has been delivering for the last several years, becomes increasingly challenging. So here you have a situation where an HDFC Bank is trading at, let's say, about 3.4, 3.5 times the March 2015 book versus an ICICI Bank which is trading at, let's say, 1.7 times March 2015 book, with the potential for re-rating in a multiples based on some of the issues on the NPL side being addressed, let's say, over the next 18 months based on economic recovery, etc. So at this point in time, I would rather play an Axis Bank and ICICI Bank, assuming all these things will, come through.
Okay, that's the call on banks from Sanjeev right now. But Sanjeev, what about this entire pack of the PSU banking names? Because the street is very divided on whether or not one should put money into PSU banks.
Well, as you know, I've never been a great fan of the PSU banks because, they tend to disappoint too often. Lending practices have never been very strong. So, there's always a case of relating from point A to point B, which is where some of the banks are currently trading at very inexpensive valuations, at least on paper. And you could see a relating from, let's say, 0.6, 0.7, where some of the PSU banks like Union Bank are trading up to, let's say, 0.91 times in a good economic scenario. But longer term, I'm not very sure about these banks because, historically they have tended to disappoint on the lending side. But if you just want to, ride the economic recovery, maybe you could take a chance with some of those banks. But if you have other options available, and we were discussing Axis and ICICI Bank, I would rather, play a somewhat safer strategy. And if I'm still making reasonable amount of return, why would I want to look at PSU banks in that case? Unless and until I really don't have any options and I have to, be invested, maybe then I could look at some of these names. But till the time I get some assurance on the lending practices, I really don't recommend these banks. And even if you look at the most recent quarter, the slippages numbers and the restructured numbers continue to be pretty high. So I'm not very sure you have seen the end of the NPL challenges over there.
Okay, Sanjeev, always good chatting with you. Really appreciate you taking the time out and speaking with us today. That's the view from Sanjeev Prasad from Kotak.